In a shocking turn of events, house prices are crashing upwards. That's right, even with 8% mortgage rates, historically low affordability, and home sales potentially hitting their lowest since 1993, September saw a new record high in home prices. These unexpected events are forcing many people to ask themselves, will the market get any better in 2024? While Wells Fargo predicts a housing recession similar to the one we saw in the 1980s, others, such as Morgan Stanley, are more optimistic and expect that prices, rents, and affordability will all improve over the next year, suggesting that the market may have just reached its lowest point. With all this uncertainty and confusion, in this video, let's discuss the current state of the housing market, explore potential significant shifts in 2024, and discuss strategies that we can all use to put ourselves in the best financial position possible, whether as a buyer, seller, renter, or just a finance nerd. To understand the current situation, we need to turn towards history and look at how real estate prices were affected during previous economic downturns. One of the first real estate crashes in American history began in 1929, right after the stock market crashed due to excessive speculation and leveraged investments. This marked the largest real estate crash in history, with property values falling by around 67%, taking nearly 30 years to recover to pre-crash levels. Over 60 years later, the 1990s presented further challenges for real estate. Until then, the market had benefited from new financing methods, inflation, and population growth. However, the savings and loan crisis led to higher interest rates, a reduction in new home constructions, and home prices remained flat until 1997. Now let's talk about the 2008 housing crash, which, based on my analytics, all my viewers are old enough to remember. To put it simply, this was caused by too many people speculating on the true value of real estate in the market, which was fueled by easy money and short-term adjustable rate mortgages that were really easy to get if you could just make the introductory payments. However, most of these mortgages had what's called a balloon payment built in, which meant that there was a big lump sum that was due a few years from when you originally took out the loan, and that, of course, led to a complete disaster. Home prices dropped by 30 to 62% in various locations. To keep the economy together, a bailout was put in place. And fast forward to 2023, property prices have reached new highs yet again. But perhaps the most interesting takeaway from all of this is that aside from the 1929 and 2008 downturns, real estate prices have generally proven to be extremely resilient. For example, in the 1940s post-World War II, there was a boom in housing prices and construction due to high demand. During the 1970s stagflation, while stocks declined, property values rose with inflation. During the 1980s recession, despite high inflation, real estate values increased by 4.5%. The 1990s saw some market downturns, but even the hardest hit areas didn't experience more than a 10% drop. Even the dot-com bubble of 2001 had very little impact on housing, as falling stock prices were accompanied by decreasing interest rates that caused home sales to reach a brand new record high. However, today the real estate market faces unique challenges that will undoubtedly influence its trajectory. Let's start with Wells Fargo's forecast of a housing market downturn similar to the 1980s recession, because it's probably not what you're expecting. This situation traces back to President Nixon disconnecting the US dollar from the gold standard, leading to uncontrolled inflation. To combat this, strict measures were put in place, including hiking interest rates up to 20% to prevent prices from skyrocketing even higher. This predictably led to a significant drop in prices. However, Wells Fargo's projection of a similar downturn in the housing market of the 1980s doesn't necessarily imply falling prices. Contrary to what one might think, Wells Fargo anticipates a continued appreciation in home prices, but at a slower rate. This is because there are fewer sellers putting their houses on the market, combined with consistent demand and limited supply. Wells Fargo projects a 1.8% increase in home prices by the end of this year, followed by a 2.5% rise in 2024, and then a 4.4% increase in 2025. So, how on earth is this even possible? Well, on the surface, most people just pay attention to nominal home prices, which is simply the sticker price today compared to the sticker price a year ago. But if you want a real understanding of how much prices increased over time, you need to take inflation into account. Let me ask you this. Would you say that making a 400% return from 1970 through 2020 is good? If you answered yes, you're wrong. Because when adjusted for inflation, there's actually a loss in net purchasing power between those years. With this perspective, the past 50 years have only seen one real decline in home prices, and that was in 2010. Adding to the complexity, home prices remained relatively stable until 1970, with increases driven by factors such as the demand for larger homes, relaxed policy changes, lower interest rates, and significant money printing. Bill McBride, from the Calculated Risk blog, notes an interesting parallel between today's real estate market and that of 1978. He pointed out that from 1978 through 1982, home prices continued going higher, but real returns, when accounting for inflation, fell by 11% over 3 years. Meaning home prices were up in terms of dollars, but down with inflation in terms of net value. Meaning people's net worths seemed to be going up, even though technically it was going down. Currently, the National Case-Shiller Index shows that median home prices have risen by 3.9% over the past year, during a period with a 3.2% year-over-year inflation rate. This indicates that the real increase in home prices is just about 0.7% over the last year, aligning with historical norms. However, some analysts have a completely different interpretation of what they think is going to happen in 2024. And this is where the debate starts. Although before we go into that, I want to let viewers of my channel know about a unique side hustle that I recently started. Most people don't even know about it, even though it's been around for over 40 years. If you want to earn an extra couple $1,000s per month from the comfort of your own home, click the link in the description to learn more. Now back to the video. Studies now show that there's a boom across various industries in terms of what customers are buying. Alright, so in terms of why some analysts disagree with the belief that home prices will continue to stay strong, look no further than Morgan Stanley, because they believe that prices are about to get a lot more affordable in 2024. Or, I guess as they say, we expect home sales to be weak in the first half of next year, but activity should pick up in the second half and further into 2025. And that's primarily because affordability will improve. They also expect that the Federal Reserve will begin lowering interest rates by mid-2024, which would prompt more sellers to sell and more buyers to obtain an affordable mortgage. In fact, they anticipate that rates will be as low as 0.4% by late 2025, meaning, according to them, we'll be back to almost 0% interest rates in just 2 years from now. The chief economist at Realtor.com also agrees with the sentiment that affordability is only going to improve from here, noting that Fannie Mae, the Mortgage Bankers Association, and the National Association of Realtors all predict that the 30-year mortgage rate will fall below 7% in the second half of 2024. However, critics point out that these organizations failed to accurately predict the interest rate hikes in 2023 and the extent of the rise in home prices, making their guess as good as anyone's grandmother's guess. Unfortunately, the downside to all of this is that it seems as though, regardless of who you ask, there's almost unanimous agreement that home prices are not likely to meaningfully fall, at least until home sellers outnumber buyers, which at this point is unlikely to happen anytime soon. Currently, the market is in a state of equilibrium with low supply and demand, leading to stagnant prices. The chief economist at Realtor.com believes that there's little room for prices to increase further, as buyers have reached their affordability limits. So then why does Redfin believe that the housing market has bottomed out? Well, to answer that, keep in mind that 2023 has been a fairly bad year for the real estate market. Like, we all know that prices didn't crash into oblivion, but inventory is at a historic all-time low, mortgage rates hit a multi-decade high, and affordability is near the worst it's ever been. So, according to the CEO from Redfin, the only good thing about the US housing market right now is that it can't get much worse from here. I sure hope I didn't jinx it. He says that the biggest differentiator in the market is that the homeowners who are selling are often required or forced to sell because of job changes, lifestyle changes, divorce, or marriage, unlike 2008, where sellers faced foreclosure risk and a race to the bottom. This dynamic indicates limited potential for a significant drop in home prices, as these sellers are generally able to meet their mortgage payments and can afford to wait for their desired price. Essentially, the market has reached a sort of impasse. It's as gridlocked as it can get. Sellers refuse to let go of their low mortgage rates at the same time that buyers cannot endlessly afford escalating prices. Analysts note that for housing affordability to go back to previous levels, one of three things has to happen: a 4.4 percentage point drop in the 30-year mortgage rate, a 62% in median household income, or a 38% reduction in home prices. Despite these factors, recent sales data shows that in October, 28% of homes sold for more than their listing price, which suggests that there was still a bidding war among would-be buyers. This suggests that in certain areas, demand remains robust. Regarding regional differences, Detroit experienced the highest annual growth in home prices at 6.7%, closely followed by San Diego with a 6.5% increase. On the other end, Las Vegas witnessed the most significant decline, with prices dropping by 1.9%. This varied landscape illustrates the diverse and complex nature of the current U.S. housing market. Now, let's get to the main question. What is the most likely scenario for the housing market in 2024 based on statistical data? Current data suggests that investors are largely betting on the Federal Reserve to start reducing interest rates around mid-2024. To be more specific, there's a 52% probability of a quarter-point rate reduction by May 2024, with expectations of additional rate cuts throughout the end of the year. Additionally, there is a record $5.7 trillion in investor and institutional funds sitting in cash-like money market accounts, many yielding above 5%. This substantial capital is capable of significantly impacting the markets once interest rates decrease. This analysis leads to the conclusion that even though by all measures the housing market is unaffordable, there's still no shortage of money out there that's willing to bid up low inventory, and that skews the market to prevent it from falling. From my own experience tracking the real estate market over the years, the current market dynamics make purchasing real estate in the short term a bad idea in most cases. Renting is currently more cost-effective in almost every market throughout the United States. The scarcity of genuinely good deals makes it really hard to find lucrative opportunities in the market. A great strategy for the time being is to rent if you're planning to move within the next 2 to 5 years, at least until the cost of buying versus renting evens out. While I'm always on the lookout for potential investments, the current market risks and low returns don't present many compelling opportunities. Commercial real estate too hasn't seen significant changes, especially with Treasury bonds yielding around 5%. Like many other investors, I'm holding cash and adopting a wait-and-see approach. Personally, I believe that a lot of these real estate predictions are just random guesses, and inevitably a few of them are going to be right by sheer luck. But if you're going to ask me for my guess on what I think is going to happen, I believe that interest rates are going to stay higher than most people think. I think they're going to stay higher for longer than most people think. And over the next few years, the housing market should begin to normalize, but it might be a very slow process. If this sounds disappointing, I have some very surprising news for you. Don't worry, it's a good surprise. Did you know that recessions are one of the best opportunities to get rich, even for everyday people like you and me? In the video showing up on your screen, I'm going to tell you simple strategies that no one else is mentioning in mainstream media. Trust me, you don't want to miss the information I'm about to share. See you there.